I need to tell you something that might seem contradictory given everything I have said over the years about index investing. I have spent decades telling people to buy a low-cost S&P 500 index fund and hold it forever. I have made public bets proving that simple index funds beat sophisticated hedge fund managers. I have told the trustee managing my wife's inheritance to put 90% of the money in an S&P 500 fund, and all of that remains true. For most people, a simple S&P 500 index fund is the best investment they will ever make. It beats the vast majority of professional money managers. It costs almost nothing. It requires no expertise or effort. It is the right choice for millions of Americans who want to build wealth without becoming investment experts. But here is what most people miss. The S&P 500 is not the only game in town. It is not necessarily the optimal portfolio for everyone in every situation. There are low-cost index funds that have historically outperformed the S&P 500 while maintaining the same passive, diversified, low-fee characteristics that make index investing so powerful. Let me tell you about a conversation that got me thinking about this more carefully. A few years ago, I was speaking at a university and a young finance professor asked me a pointed question. She said, "Warren, if you believe in efficient markets enough to recommend index funds, why do you spend your time picking individual stocks? And if you believe you can identify mispriced securities, why not recommend factor-based strategies that systematically capture the same characteristics you look for?" It was a good question. The honest answer is that for most of my career, the low-cost factor funds that exist today simply did not exist. You could not access quality factor exposure or dividend tilts through cheap passive vehicles. You either picked stocks yourself, which requires skill and time most people do not have, or you bought actively managed funds that charged high fees and usually underperformed anyway. The S&P 500 index fund was the best practical option for ordinary investors. But that has changed. Today, there are exchange-traded funds that provide systematic exposure to factors like quality, value, and dividends at expense ratios barely above plain vanilla index funds. These funds did not exist when I started recommending index investing. Now they do, and ignoring them simply because I have always recommended the S&P 500 would be stubborn rather than wise, Tode. I am going to share 3 Fidelity ETFs that have delivered returns exceeding the S&P 500 over meaningful time periods. These are not actively managed funds with expensive fees. These are not complicated strategies that require constant monitoring. These are simple, low-cost funds that give you exposure to factors and sectors that have historically generated superior returns. Now, before you dismiss this as a contradiction of everything I've preached, let me explain the logic. The S&P 500 is a market capitalization weighted index of large American companies. It is an excellent investment, but it is just one way to slice the market. Other slices, based on factors like quality or dividends or specific sectors, have generated higher returns historically. Accessing those slices through low-cost index funds is not abandoning the principles of passive investing. It is applying those principles more strategically. Let me take you back to something I learned early in my career that shaped how I think about this. When I was building Berkshire Hathaway's portfolio, I was not trying to own the average American business. I was trying to own better than average businesses at fair prices. I looked for companies with durable competitive advantages, strong returns on capital, consistent earnings, and shareholder-friendly management. I was not satisfied with average. I wanted quality. The stocks I bought tended to share certain characteristics. They had high returns on equity. They generated substantial free cash flow. They had manageable debt levels. They had competitive moats that protected their profitability. When I look back at my most successful investments, they almost all fit this profile. Coca-Cola, American Express, Apple. These were not average companies. They were exceptional companies that I held for decades. Now, here is what is interesting. Academic researchers have identified these same characteristics as factors that predict stock returns. They call it the quality factor. Companies with high profitability, stable earnings, low debt, and strong balance sheets tend to outperform the broad market over long periods. This is not just my experience. This is documented across decades of data, across different time periods, across different countries. The S&P 500 owns all 500 large cap stocks regardless of quality. Some are exceptional businesses, some are mediocre, some are troubled companies on the verge of decline. You own them all in proportion to their market capitalizations. But what if you could tilt toward the higher quality companies while still maintaining broad diversification and low costs? That is exactly what certain factor-based ETFs allow you to do. The first Fidelity ETF I want to discuss is FQAll, the Fidelity Quality Factor ETF. This fund tracks an index of U.S. stocks selected based on quality characteristics. High profitability, strong balance sheets, stable earnings. These are exactly the characteristics I have looked for throughout my career when selecting individual stocks. The expense ratio on FQAll is 0.29%. That is higher than the cheapest S&P 500 funds, but still very low compared to actively managed funds. And the historical evidence suggests that quality stocks outperform enough to more than compensate for the modestly higher fee. Let me explain why quality outperforms, because understanding the logic will give you conviction to stick with this approach. Quality companies generate high returns on capital. When they reinvest their earnings, they earn high returns on those reinvested earnings. This creates a compounding effect that mediocre companies cannot match. A company earning 20% on equity that reinvests half its earnings grows its intrinsic value much faster than a company earning 10% on equity with the same reinvestment rate. Quality companies also tend to have more stable earnings, which means less risk of permanent capital loss. They can weather recessions without cutting dividends or taking on excessive debt. They emerge from downturns stronger than weaker competitors who struggle or fail. This downside protection is valuable even if it does not show up in average return statistics. The quality factor has delivered excess returns over the broad market across multiple decades of data, not every year. Not even every decade consistently, but over 20 and 30-year periods. Quality has outperformed for a patient investor with a long time horizon. That historical pattern suggests quality exposure can enhance returns without taking on additional risk. Let me give you some concrete numbers, because understanding the magnitude matters. Studies of the quality factor going back to the 1960s show a premium of roughly 3 to 4% annually over the broad market. That premium has not been constant. There have been extended periods when quality lagged, but the long-term average is meaningful. Now, 3 to 4% might not sound like much, but let me show you what it means over an investment lifetime. If you invest $100,000 and earn 10% annually for 30 years, you end up with approximately $1.7 million. If you earn 13% annually, which is what adding a 3% quality premium would give you, you end up with approximately $3.9 million. The quality premium more than doubles your terminal wealth over a 30-year period. Of course, past performance does not guarantee future results. The quality premium could shrink as more investors recognize and pursue it. Academic research suggests that factor premiums tend to diminish once they become widely known. But quality has a logical foundation that suggests it should persist. Companies with strong balance sheets and stable earnings really are better positioned for long-term success. That is not just a statistical artifact. That is business reality. I want to be clear about something. Tilting toward quality does not guarantee outperformance. Factors go through extended periods of underperformance. Quality stocks have lagged the broad market at times, sometimes for years. If you expect immediate results, you will be disappointed and tempted to abandon the strategy at exactly the wrong time. This is a long-term approach that requires patience measured in decades. But here is my perspective. If I am going to own stocks for 20 or 30 years anyway, I would rather own quality stocks than average stocks. The long-term evidence supports this preference. and it aligns with everything I have learned about what makes businesses valuable over extended periods. The second Fidelity ETF I want to discuss is FDVV, the Fidelity High Dividend ETF. This fund focuses on stocks with high dividend yields while also screening for sustainability of those dividends. It is not just chasing the highest yields, which can be dangerous. It is looking for companies that pay substantial dividends and have the financial strength to maintain them. The expense ratio on FDVV is 0.29%, the same as the quality fund. Again, modestly higher than the cheapest index funds, but still very reasonable for what you are getting. Dividends have been a source of returns that many investors underappreciate. Over the past century, dividends have contributed roughly 40% of the total return from stocks. Not price appreciation. Dividends, reinvesting those dividends to buy more shares, creates a compounding effect that dramatically increases wealth over time. High dividend stocks tend to have certain characteristics that I find attractive. They are often mature companies with stable business models. They generate more cash than they need to reinvest for growth, so they return the excess to shareholders. They tend to be disciplined about capital allocation because paying dividends imposes constraints. Management teams cannot waste money on empire building if they are committed to returning cash to owners. Dividend-paying stocks have historically been less volatile than non-dividend-paying stocks. During market downturns, the dividend provides a cushion. Even if the stock price falls, you are still receiving income. That income can be reinvested to buy more shares at lower prices, which accelerates recovery when markets rebound. This psychological benefit helps investors stay invested through difficult periods rather than panicking and selling at the bottom. The dividend growth component is particularly important. Companies that consistently increase their dividends tend to be companies with growing earnings and strong competitive positions. The dividend increase is a signal from management that they expect continued prosperity. A portfolio of dividend growers has historically outperformed the broad market while providing growing income for investors who need cash flow. I want to share a personal story that illustrates why dividends matter so much to me. When I bought Coca-Cola stock back in 1988, the company was paying a dividend of around 6 cents per share on a split-adjusted basis. Today, Coca-Cola pays over $1.80 per share annually. That is a 30-fold increase in the dividend over roughly 35 years. What does that mean in practical terms? It means that based on our original purchase price, Berkshire now receives a dividend yield of well over 50% on our original investment. Every year, we receive more than half of our original investment back in cash dividends alone, and we still own all the shares, which have appreciated enormously. The dividend growth turned a good investment into an extraordinary one. This is the magic of dividend growth investing. When you buy companies that consistently raise their dividends, your yield on the original investment grows over time. What starts as a 3% yield becomes a 5% yield, becomes a 10% yield as the company increases payouts year after year. Eventually, the dividends alone generate returns that exceed what most investors earn from total return strategies. Now, some people argue that dividends are irrelevant, that $1 of dividends is no different from $1 of capital gains. From a purely theoretical perspective, this is true, but from a practical and psychological perspective, dividends matter. They provide tangible returns that do not depend on selling shares. They impose discipline on management. They attract a stable shareholder base that reduces volatility. These practical benefits translate into better outcomes for most investors. There is also a behavioral benefit to dividends that researchers have documented. Investors who receive dividends are less likely to sell during downturns. The cash income provides reassurance that their investments are working even when prices are falling. This behavioral stability leads to better long-term outcomes because these investors do not panic and sell at market bottoms. I have always appreciated the dividend checks I receive from our holdings. There is something satisfying about receiving cash payments from businesses you own. It reminds you that You are not just speculating on stock prices, you are an owner of real businesses that generate real profits and share those profits with you. The third Fidelity ETF I want to discuss is FTC, the Fidelity MSCI Information Technology ETF. This fund owns the technology stocks in the MSCI USA Index, giving you concentrated exposure to the sector that has driven so much of the market's gains over the past decades. The expense ratio on FTC is 0.08%, which is extraordinarily low for a sector fund. You are getting focused technology exposure at a cost barely above the cheapest total market funds. Now I know what some of you are thinking, Warren. You famously avoided technology stocks for most of your career. You said you did not understand them. Why are you now recommending a technology ETF? Let me address this directly. I did avoid technology for a long time because I did not feel I could predict which companies would maintain their competitive advantages over decades. Technology changes rapidly. The dominant company today can be obsolete tomorrow. This unpredictability made me uncomfortable. But I have learned and evolved. My investment in Apple taught me that certain technology companies have built moats that are just as durable as any consumer brand or industrial franchise. Apple's ecosystem, its brand loyalty, its installed base of users, these create switching costs that protect the business from competition. Once I understood this, I made Apple one of our largest positions more broadly. I have come to appreciate that technology is not a separate sector that you can avoid. Technology is transforming every industry. The dominant companies of the next several decades will be technology companies or companies that have successfully integrated technology into their operations. Underweighting technology means underweighting the future. Think about what technology companies have accomplished in the past 2 decades. They have created entirely new industries. They have disrupted incumbents across every sector. They have built platforms with billions of users. They have generated cash flows that rival the GDP of small countries. The scale of wealth creation in technology has been unprecedented in business history. Amazon transformed retail and then transformed enterprise computing with cloud services. Google organized the world's information and built a digital advertising empire. Microsoft became essential infrastructure for virtually every business on Earth. Apple created devices that billions of people consider indispensable. These are not speculative companies. These are dominant franchises with entrenched competitive positions. The historical returns of technology stocks have dramatically exceeded the broad market. This is not guaranteed to continue. Valuations are higher, growth rates may moderate, but the fundamental drivers of technology outperformance remain intact. Software economics with near zero marginal costs, network effects that entrench dominant platforms, the continued digitization of the economy. These forces suggest technology will remain a growth engine for decades to come. I should mention something about the risks specific to technology investing. Technology companies can become obsolete faster than companies in other industries. The dominant technology company of one decade can be irrelevant in the next. IBM dominated computing for decades and then was eclipsed by Microsoft and Intel, who were then partially eclipsed by Google and Amazon and Apple. The turnover at the top is faster in technology than in other sectors. This risk is mitigated somewhat by owning an ETF rather than individual stocks. When a technology company stumbles, it shrinks in the index and is eventually removed. New winners grow and take its place. The ETF automatically adapts to the changing technology landscape without you having to predict which companies will succeed and which will fail. You capture the sector's growth without having to identify the specific winners. A concentrated bet on technology does carry more risk than a diversified portfolio. Technology stocks are more volatile. They can fall further in downturns. A single sector fund should not be your entire portfolio. But as a component of a diversified portfolio, technology exposure can enhance long-term returns for investors willing to accept the volatility. I want to discuss how to think about combining these funds with a core S&P 500 position because implementation matters as much as fund selection. The most conservative approach would be to keep the majority of your portfolio in a broad market fund like the Fidelity 500 Index Fund or Vanguard's VOO, and then add smaller positions in these factor and sector tilts, perhaps 70% in the broad market and 10% each in quality, high dividend, and technology. This maintains broad diversification while capturing some of the potential excess returns from the tilts. A more aggressive approach would increase the tilts at the expense of the broad market, perhaps 50% broad market and 50% split among the factor and sector funds. This increases your active bets and could lead to either higher returns or higher underperformance, depending on how the factors perform. Let me share how I would think about this for investors at different life stages because age and circumstances matter enormously. For a young investor in their 20s or 30s with decades until retirement, I would suggest a more aggressive tilt. You have time to recover from extended underperformance. You have the luxury of thinking truly long-term. A portfolio with perhaps 50 to 60% in broad market funds and 40 to 50% in factor tilts could make sense. Within the factor allocation, I would emphasize quality and technology over dividends since growth matters more than income at this stage. For a middle-aged investor in their 40s or 50s, approaching peak earning years, I would moderate the tilts somewhat, perhaps 60 to 70% broad market and 30 to 40% in factor tilts. Start shifting some of the factor allocation toward the high dividend fund since income becomes more important as retirement approaches. Reduce technology exposure slightly since you have less time to recover from a major technology correction for an investor in their 60s or beyond approaching or in retirement. I would emphasize stability in income, perhaps 70 to 80% broad market and 20 to 30% in factor tilts, with the majority of the tilt allocation in the high dividend fund. Technology exposure should be modest at this stage. The quality tilt remains appropriate because quality stocks tend to be less volatile and more resilient in downturns. These are general guidelines, not prescriptions. Your specific situation, risk tolerance, other sources of income, and financial goals should all influence your allocation. But the principle remains the same. Tilt toward growth factors when young, tilt toward income and stability factors as you age. The right allocation depends on your conviction, your time horizon, and your tolerance for tracking error against the broad market. Tracking error means periods when your portfolio performs differently from the S&P 500. Sometimes better, sometimes worse. If seeing your portfolio lag the market for a few years would cause you to abandon the strategy, you should stick with smaller tilts or no tilts at all. I want to address why I am highlighting Fidelity funds specifically. Fidelity has become extremely competitive on costs. Their expense ratios are as low as anyone in the industry. They offer commission-free trading on their platform. They have excellent customer service and technology. For many investors, Fidelity is the most convenient and cost-effective home for their investments. That said, these same concepts apply to similar funds from other providers. Vanguard, Schwab, and BlackRock all offer quality factor, high dividend, and technology sector funds with low expense ratios. The specific fund matters less than the underlying exposure you are getting. Choose the provider that offers the most convenient and lowest cost access for your situation. Let me share some data that illustrates why these tilts have value over long periods. Over the past 20 years, the S&P 500 has delivered excellent returns, approximately 10% annually. But quality stocks, as measured by various quality indices, have delivered roughly 11 to 12% annually. That 1 to 2% annual difference compounds into enormous wealth differences over decades. Own $100,000 invested in the S&P 500 at 10% for 30 years becomes approximately $1,700,000. The same investment at 11% becomes approximately $2,300,000. At 12%, it becomes approximately $3 million. Small annual differences create massive terminal value differences through the power of compounding. High dividend stocks have similarly outperformed over extended periods, though with different characteristics. The outperformance is smaller in magnitude, but comes with lower volatility and more consistent income. For investors who need cash flow or who struggle with volatility, high dividend strategies can improve outcomes even if the total return advantage is modest. Technology has been the standout performer over recent decades. The sector has returned roughly 15% annually over the past 20 years, compared to 10% for the broad market. That 5 percentage point annual advantage has created enormous wealth for technology investors. Whether this continues depends on whether technology companies can maintain their growth rates and profitability advantages. I want to be very clear about the risks of this approach. Factor investing is not a free lunch. Factors can underperform for extended periods. Quality stocks underperformed growth stocks for much of the past decade. High dividend stocks have lagged during periods when speculative growth stocks dominated. Technology crashed brutally in the early 2000s and took over a decade to recover. If you adopt these tilts, you must have the patience to hold through periods of underperformance, if you will. Abandon the strategy after a few years of lagging the S&P 500. You will likely sell at the worst time and end up worse than if you had just owned the broad market from the start. These strategies require conviction and patience measured in decades, not months or years. The behavioral challenge is significant. When your portfolio lags the benchmark, you will feel like you made a mistake. Your friends who own plain vanilla index funds will be beating you. Financial media will question factor investing. You will be tempted to abandon your tilts and just own the market. This is exactly when you should hold firm. But it is exactly when most people give up. Let me also address the tax implications of factor and sector funds. These funds tend to have higher turnover than total market funds because their underlying indices rebalance more frequently. Higher turnover can generate more taxable capital gains distributions for taxable accounts. The tax drag can reduce the benefit of the tilts. Factor and sector funds are most advantageous in tax-advantaged accounts like IRAs and 401ks where the turnover does not create immediate tax consequences. I want to share my perspective on why this approach aligns with sound investment principles even though it goes beyond simple broad market indexing. The core insight of index investing is that most active managers fail to add value after fees. They cannot consistently identify mispriced securities. They cannot time the market. Their trading and research costs create a headwind that they cannot overcome. Passive investing wins by minimizing these costs and capturing market returns. Factor investing maintains these principles while adding a systematic tilt toward characteristics that have historically predicted higher returns. You are not trying to identify individual mispriced stocks. You are not trying to time when to be in or out of the market. You are simply owning a diversified portfolio that tilts toward certain characteristics. The costs remain low, the approach remains passive and systematic, but the expected returns are slightly higher based on historical evidence. This is not the same as active management. Active managers make discretionary decisions about which stocks to buy and sell. They try to outsmart other investors through superior analysis or information. Factor investing does neither. It simply applies rules based on characteristics that academic research has shown to predict returns. The difference is fundamental and important. I have always believed in understanding why an investment approach works. For broad market indexing, the logic is that you capture the returns of capitalism while minimizing costs. For factor investing, the logic is that certain characteristics like quality and dividends are associated with better long-term business outcomes that translate into higher stock returns. Both logics make sense to me. Both approaches are consistent with how I think about investing. Let me close with some practical advice for implementing this approach. Start with your core allocation in a broad market fund. This ensures you capture the overall market return regardless of how factors perform. The core should be the majority of your equity allocation. I would suggest at least 50% and perhaps as much as 70% in a plain vanilla total market or S&P 500 fund. Add D factor tilts gradually. Do not make dramatic portfolio changes all at once. If you are going to tilt toward quality or dividends or technology, build those positions over time. This reduces the risk of implementing the changes at exactly the wrong moment. You might add to your factor positions over 12 to 24 months rather than all at once. Maintain your tilts through all market conditions. Do not add to winning tilts and reduce losing tilts. This is chasing performance, which destroys returns. Rebalance periodically to maintain your target allocations, which forces you to buy more of what has lagged and sell some of what has outperformed. Annual rebalancing is sufficient for most investors. Keep costs as low as possible. The advantage of factor tilts is small, perhaps 1 to 2% annually. If you pay 1% more in fees, you have eliminated the entire benefit. Use the lowest cost funds available for your factor exposures. The Fidelity funds I have mentioned are among the cheapest options available. Stay patient. Factor premiums take decades to manifest reliably. You will experience extended periods of underperformance. This is normal and expected. Do not abandon the strategy during these periods. The worst thing you can do is adopt factor tilts and then abandon them after a few years of underperformance. That locks in the losses without capturing the eventual gains. Consider tax location carefully. Put higher turnover factor funds in tax-advantaged accounts. Keep the lowest turnover broad market funds in taxable accounts. This minimizes the tax drag from the more active rebalancing in factor funds. Do not overcomplicate your portfolio. 3 to 5 funds is plenty for most investors. Owning 10 or 15 different factor and sector tilts adds complexity without adding value. The more funds you own, the harder it becomes to maintain discipline, and the more likely you are to tinker at exactly the wrong moments. Review your strategy annually, but do not change it frequently. Look at your allocations once a year to ensure they still align with your goals and risk tolerance. But resist the temptation to adjust based on recent performance or market forecasts. The strategy should be set and maintained for decades, not adjusted quarterly based on what happened recently. Keep good records for tax purposes. Factor funds may generate more capital gains distributions than total market funds. You need accurate cost basis information for tax reporting. Most brokerages provide this automatically, but verify that your records are complete. Consider your overall financial situation. These factor tilts are appropriate for long-term investors with decades until retirement. If you need your money in the next 5 or 10 years, the volatility of factor strategies may not be appropriate. Stick with more conservative allocations for short-term money. The 3 Fidelity ETFs I've discussed today, FQL for quality, FDVV for dividends, and FDTC for technology, represent thoughtful tilts that can potentially enhance returns beyond a simple S&P 500 fund. They maintain the low-cost passive approach that makes index investing powerful while capturing factors that have historically generated excess returns. This is not for everyone. Many investors should simply own a total market fund and leave it alone. The simplicity has value. The reduced decisions means reduced opportunities for mistakes. If you are unsure whether factor tilts are right for you, they probably are not. There is no shame in owning a simple S&P 500 fund for your entire investing career. That approach will build substantial wealth over time. But for investors who understand the logic, who have the patience to hold through underperformance, who want to optimize their portfolios beyond basic indexing, these funds offer a sensible approach. You are not abandoning the principles that make passive investing work. You are applying them more strategically. The key insight I want to leave you with is this. The S&P 500 is not the only way to invest passively. It is not the only way to get low costs and broad diversification. There are other approaches that have historically delivered better returns while maintaining the same passive, systematic characteristics that make index investing superior to active management. Fidelity and other providers now offer access to these approaches at costs low enough to preserve most of the excess returns. Stop settling for average if you have the conviction to reach for something better. But only reach if you truly understand what you are reaching for and have the patience to wait for the results. The commitment must be measured in decades, not years. If you have that commitment, these factor tilts can potentially add meaningful wealth over an investment lifetime.